value would appreciate. So the value of the stock would appreciate. Usually when they are going to sell stocks, they will tell you that, oh, for every unit of the shares that you buy, it will be X amount of money. But as a stock or as a company does well, the share value would go up because now they are doing better than they were doing previously. So if you own a part of it, the value will go up. And so if the value is going up, then you have what is called capital gains. So two sources of income when you are investing in stocks. You can get dividends if the company declares dividends. And then two, if the price of the stock goes up, if the value of the stock goes up, then you can also get capital gains. Now, let me say that investing in stocks is a bit more complex than maybe the next investment class that will follow. It's a bit more risky in that if you invest in stocks, the value of the stocks could go up or it could plummet. Let me give you a practical example. So a couple of years ago, there was a company, I'm not going to name it for obvious reasons, and they came to float shares in dollars. And I was so excited about it. And I decided I was going to invest in that company. So I bought a lot of their stocks. Not too long after that, the value of the stocks plummeted so badly that I think I've lost well over 60%, even 70% of the value of the stocks as I bought them. And so today, the stocks are worth less than I bought them for. So the challenge with investing in stocks is that the value can go up so high, at the same time, the value can drop so low. And so you can even lose the initial capital that you invested in it. But if the value goes up very well, then you can also make a lot of money from it. So stocks are risky in that you can lose even the capital that you invested in. Typically, those people who invest in stocks would want to understand the company that they are investing in. And so they will use various analysis to be able to determine if indeed the stocks are undervalued or overvalued. If they are undervalued, then they would want to buy because they believe the value would go up and they will gain. If they are overvalued, then they don't want to buy. And even if they have a holding, they want to sell it off so that they don't lose money on it. So equities can be very rewarding, but at the same time, it poses a lot more risk to us. All right. The next asset class is what we call fixed income investing or bonds. A bond typically means that you are lending money to somebody. It could be a government, it could be a corporate organization, with the intent that that borrower is going to pay you back your principal at a predetermined date. And within the period, they will be paying you what we call coupons, or let me loosely call them interest. So I give money to the Ghana government for 1 year and tell the Ghana government, or the Ghana government would say, okay, every 6 months, I'll give you interest on your money that you've given to me. And at the end of the year, I'll give you back your money plus whatever interest is left. Have bonds, all are fixed income investment because you know what returns you are going to make at the end of the day. It's fixed, it's predetermined. Now, they are a very interesting asset class to have because of their relatively low risk. That's low risk. And typically, when you take a bond, let's say when you take a 1 year bond, at the end of every 6 months, some income will come to you. So your interest income will come to you every 6 months. It's called the coupon. So the coupons are paid to you every 6 months. And the rate that the bond issuer states before they issue the bond is called a coupon rate. So let's take a typical example. I remember there was a 10-year bond which was pegged at 19%. So if you invest in that bond, in that 10-year bond, what it means is that you are agreeing to hold your money for 10 years. And at the end of every year, or at the end of every 6 months, they will pay you half the interest that you would have earned for the year. So if you invested 100,000, then you know that at the end of the year, you are getting 19,000. So every 6 months, you get 18,500 or 18,500 cedis. Is my calculation right? No, 19,500 every 6 months. And so that is what fixed income is about. you know what coupons you're going to get. And at the end of the period, they give you back your principal. Now, fixed income investments have secondary markets. So if, for instance, you decided to buy a 10-year bond, but during the period you realize, I cannot hold it for 10 years, you can go on the secondary market and sell it off. At the same time, if there's a fixed income that you really wanted to have, but you could not have due to whatever, then you can go to the secondary market, and if that bond is available, you can buy it and add it to your portfolio. So that's for fixed income. The other asset class that I want to talk about is part of what we call derivative investments. There are several of them, as I mentioned, but I'll just speak to just one of them. So it has become very common in our market now to have what we call collective investment schemes. And this is how collective investment schemes work. Typically, there will be a fund manager for the collective investment scheme. And that fund manager will pool all funds together. So Daniel wants to invest in that scheme. Pastor TK wants to invest in that team. Patience wants to invest in that team. Fojo wants to invest in that team. Shola wants to invest in that team. And so they pool all the monies together into a pool. And depending on the mandate of that investment scheme, the fund manager would then invest the monies in those investments. And the returns that come would then be shared amongst the investors in the pool according to the percentage that you have. Typically, what will happen is that the fund manager will determine what the value of the fund is at any point in time. And so there will be a price to the investments that you make. And that will determine what we call the NAV, or the value of a unit share in that pool. And so examples of collective investment schemes are mutual funds. We can have money market mutual funds. So money market mutual funds simply means that after collecting all the pool of funds, they only invest in fixed income investments. They don't do equity investments. And so they might buy government of Ghana bonds or treasury bonds, treasury bills, treasury bonds. They might buy some corporate bonds, etc., etc. Let me say something before I continue. So with the previous slide, governments can issue bonds, and corporate organizations can also issue bonds. So you can have a company, maybe a very big company, say that I'm an A-rated company. I want to go for fixed income. So I float bonds for people to buy, and then I'll pay them back their money at a specified period of time and pay interest every 6 months. All right, so if you have a mutual fund, it's derived then from a fixed income investment. So in this case, the fund manager would only invest in fixed income. And so the risk there is much lower. However, the returns are also much lower. All right. If the collective investment scheme is an equity mutual fund, what it means is that the fund manager will be investing in equities of companies. So they might buy some stocks in X company, buy some stocks in Y company, and the incomes or the dividends and the capital gains that are accrued, they use it then as basis to distribute the incomes amongst the fund owners. There can also be a hybrid of equity and fixed income as the underlying mandate. And so collective investment schemes have become very popular. And it's because the risk is shared amongst various investors. So it's not just you going to buy the investment, but a couple of people are coming together to pool monies together to buy. And the second thing is that there's diversification. You are able to invest in several other mutual funds, several other assets classes. So be it equity, be it fixed income, depending on the mandate. So there's diversity of the investment. You don't put all your pooled funds into just one company. So those are collective investment schemes. And they've become very popular even in our country here in Ghana, and I'm sure in other places in the world. So for instance, maybe to give a few examples, in First Bank, we used to have what we call First Fund and Heritage Fund. Those were mutual funds that were running on fixed income. So First Fund was a fixed income investment, and then equity. Heritage Fund was an equity investment. In Data Bank, I think they had the M fund to represent the money market fund, so fixed income. And then they had EPAC, which was an equity mutual fund. So there are several people who are doing collective investment schemes. And they give the advantage of both shared risk and diversification. And so that is for us to also know. Now, what are the other asset classes? There are several other asset classes. Some may invest in commodities, so gold, soybean, maize, you name it. Those are commodity investments. Some invest in real estate. So by real estate, I mean real estate generating investments. So to give you an example, not too long ago, I saw an advert by a company that has built a number of apartments all over Accra in very prime areas. And they ask you to come and invest in it. They rent out the apartments, and the rental income that comes, they share it amongst all those who have invested in it. So with derivative investments, there's an underlying asset class. It could be fixed income, it could be real estate, it could be anything. At the end of the day, they will share the incomes that accrue from those investments amongst the people who have invested in it. So there are several other asset classes. Now, one of the interesting things about derivative investments and alternative investments are that they are higher or high risk investments. And so you can lose your money very easily. But at the same time, they are very high reward investments. So you can make tons of money by investing in them if you know it, if you know what it is about and you've mastered it. And so before you attempt to invest in commodities, derivatives, you invest in Forex or foreign exchange, you invest in futures and swaps, you need to be very careful that you know what you're doing. It's not something that you jump into it without any prior knowledge. You need to be very careful and know exactly what is happening before you jump into it. But they have potential to give you very high rewards. And the high rewards come from a couple of reasons. One of them being what is called leverage. So by leverage, you are able to take a small amount of money to command a very high investment. So for instance, if you're trading in foreign exchange, you typically would have the ability to maybe go for about 400 times, 500 times the amount of money that you have. So assuming you have just about $100 or $1,000. With $1,000, you can actually buy lot sizes or buy investments, which could be about $4,000, even though you have just $1,000 in your account. So that is what is called leverage. Being able to use leverage to take in more investments or take the risk to get more investments than your actual money is. Whereas this is a very good thing, it is also a very, very dangerous thing. The same way you can make so much money, you can also lose all your money if you're going for leveraged investments. And so again, the caution here is that be very minded when you want to attempt some of these ones. They can be very lucrative, but they can also be very, very damaging to you. So there are various other asset classes beyond fixed income and equity, but they represent higher leverage and higher risk to us. All right. So know your investment strategy. Now, of the things that I've mentioned today, that there are some key takeaways that I want us to have. And one is that know how you want to invest. So the first group of investors that I want to talk about are people who buy investments that are already packaged. So the ones that I mentioned earlier are typically investments that are packaged. So you buy them off the shelf. So you go to your stockbroker or you go to your investment advisor and say, okay, I have some excess funds. I want to invest. And the person will speak to you about your risk and your returns objectives. They'll look at your circumstances. How much time do you have? How old are you? What are your task considerations? What are your unique circumstances? If, for instance, you are a religious person that is against the use of your money for some things, for instance, you don't want to invest in a tobacco producing company, you tell the investment advisor that, hey, I don't support tobacco, and so I don't want my money to be invested in a company that produces tobacco. Or I don't want to use my money to support companies that produce firearms, etc.